Welcome everyone. So, just as we know in the game of cricket, the most important part is to stay in the game and the runs will eventually come. Similarly, in the game of investment, the more we are in the market, we are staying in the market, the more runs, the more profits we will be getting over the period of time. So there will be a question in our mind that what I can do to stay put in the game of investment. And the answer to staying put in the game of investment journey is by keeping risk in our control. Remember guys, we don't control the markets, market control us. So this video is going to be all about it. We are going to understand different types of risk. We are going to understand risk itself, what is risk in very simple terms, and how to mitigate the risks in the market. In this video, we are going to learn about risk in very simple terms, what regulators in Indian markets, the regulator is SEBI, how are they spreading awareness, what are they doing to increase the participation of investors in the markets, and we will learn about different types of risks that an investment possesses before we invest in the markets. We will also learn about how we will be mitigating those risks. So we have heard a lot about these jargons, these tough words that mutual funds sahi hai, the investment in the markets is subject to market risks, you have to read all the documents related to the scheme, and obviously a phrase that we all have heard about, that risk hai to isk hai. So what is it? So what is risk? Risk in simple terms is surprise. Surprise, it is also uncertainty of something happening. Mainly those surprises which can cause loss or damages. If these surprises are favorable, then it causes opportunities. As an investor, we want to earn profits fast. We want to earn large profits very fast. And how do we want them to occur? We want them to occur by these surprises. So an investor takes risk. So we have understood one thing, that opportunities and risk both are two sides of a coin. We cannot have one without the other. Now, we have heard that a lot of traders and investors lose money. How do they lose money? Why do they lose money? They lose money in the markets because of their poor management of the risk. So what regulators are doing? Regulators are promoting investments that are less risky. And even though they are providing less riskier investment instruments, they are also giving a disclaimer in detail about the risk associated with investment. We all have heard about mutual fund sahi hai. Have we ever thought what is mutual fund sahi and why is mutual fund sahi hai? Because mutual fund sahi hai is one of the most popular campaign run by Association of Mutual Funds in India since 2017. They have been promoting investor participation in the markets by promoting mutual funds investment which are less risky than the direct investments into the equities. As a part of this serious campaign of mutual funds sahi hai, they are giving an elaborate disclaimer. The disclaimer contains mutual fund investments are subject to market risks. Read all the scheme related documents carefully before investing. The disclaimer is to inform an investor that there are no guaranteed returns in the market and the investor has to take ownership of profit as well as the losses that they get from the market. Now let's understand market risks. What are the types of market risks? The first risk associated with the market risk is interest rate risk. So the interest rate risk is the risk of changing of the interest rates in the market by the Federal Bank or the RBI in India. Now the change in this interest rate causes the change of the cost of borrowing. Due to the change of cost of borrowing, the profits of the company can get affected. The second risk is the equity risk. The equity risk is basically the volatility and a potential decline in the price of the stock or a company because of any company specific risk, such as there can be a fire in the company plant, or there can be a flood, there can be huge nationwide strike of the workers of those company. So there are a lot of risk associated with a company that can affect the price of the equity of the company. Even the fraud in a company can make stocks illiquid. We have some examples such as the Yes Bank and the Satyam Computers. The third risk is the currency risk. The currency risk can be caused due to fluctuation in the exchange rates of the currency pairs. Now the companies doing export or import of their products or services will be subject to this risk. The fourth risk is the commodity risk. The commodity risk can be caused due to the change in prices of the commodities. Now the change of the price of the commodities can inflate or deflate the prices of the raw material of a company, eventually affecting the results of the company. For example, recent oil spike in US-Iran war. Now the question is, how can I mitigate these risks? The first step is diversification. Spreading your capital across various asset classes and geographies can help you mitigate the risk in the specific market. There is a very famous saying that you don't put your all eggs in one basket. A proper asset allocation strategy with timely rebalancing can reduce your drawdown of the portfolio. The second way to mitigate your risk is systematic investment plan, SIPs. Instead of investing lump sum amount in one go, you can stagger your investments over time. This approach of staggering your investment over the time is called dollar cost averaging. The third strategy is using derivatives for hedging. Now, using derivatives for hedging is a very advanced strategy that huge institutions use, such as using futures and options to lock in their future prices or create a downside protection against their market drawdown. And it is difficult for a retail investor to implement this strategy. The fourth strategy is using stop loss. Predefined loss per trade minimizes your losses when your decision go wrong. Basically, ungli काटो वरना हाथ काटना पड़ जाएगा. Fifth strategy to mitigate your risk is by purchasing medical insurance. Personal medical emergencies can cause an investor to sell his investment in inappropriate time. To avoid this scenario, one should buy a medical insurance. In the coming videos, we will be diving deep into how to apply these strategies to a retail investor portfolio. Thank you everyone for watching my video. Please like, share and subscribe.